Hi, this is Carl Saz with Verde Capital Management. This video is going to focus on our upcoming recession risk forecast, as well as address some of the questions that many of you have asked about the recent market volatility that we've seen in 2022 and specifically in the month of January. So let's get started. So typically, when watching the financial news, you'll see that this is what we call the wall of worry. These are the different events that are impacting financial markets today and are giving investors anxiety around the future and some of the things that are happening in the marketplace. So we all know about COVID-19. We've been living with it now for upwards of 2 years. And the most recent Omicron variant, which came out towards the tail end of last year and has been kind of causing a major surge in infections and cases. In addition to that, there's the worry about inflation, which recently peaked at around 7% at the end of last year. Populism's on the rise, the 2022 midterm elections, stock market valuations, the dollar debasement. And while some of these issues are possible, others are probable. And most investors have a really hard time distinguishing between those two, what's possible and what's probable. And this leads to a variety of different panic attacks that you can see on this slide. And these panic attacks really have happened, fairly frequently. It seems like every 12 to 18 months we get another one. And these are not necessarily correlated to recessions, but they do cause a lot of damage, at least in the short term. So what this graph shows here is just the most recent 6 years and the panic attacks that have happened during that time. So for example, if you had just kind of fallen asleep and invested your money in the stock market, you would have almost tripled your money over the last 5 to 6 years. However, because we don't do that, we kind of stay awake and we pay attention to what's going on. You can see a number of different issues that have happened over the years, some small, some big, but at the time, all of them would have caused our clients anxiety. So Brexit, for example, which was Britain exiting the Eurozone back in 2016, or when oil bottomed back in the end of 2015 at $27 a barrel. Trump's impeachment scare in 2017, the North Korea crisis, the most volatile time was when the government was shut down back at the end of 2018 and early 2019. Now, very few of us remember that anymore, but at the time, it actually caused the year 2018 to become a negative year for us, and the market dropped a lot during that time. Of course, when the government did reopen back up, we see that actually markets recovered very quickly from that. But that panic attack was obviously very troubling. We see COVID-19, which of course was a very large panic attack. Now this one took a little while to recover, but we see the most recent one related to the Omicron variant and heightened inflation. So this is the one that we're living through today. So panic attacks, we want you to think of like storms. Right? They can cause a lot of damage, but they're over with quickly. So what do you do about storms, right? Nothing. You kind of wait them out, right? They're very unpredictable. They can come through. They're typically going to be very quick, and so you wait them out. And just like that, we do that when we have panic attacks that hit like this. If you react to every panic attack and let's say sell every single time the market has one of these modes of panic that they're in, it can actually lead to very poor investor performance. And this is something that we've seen throughout our time as financial advisors, but really even in data that's reflected going back 30 years. And this is why many of us that are financial advisors got into the business, is because we noticed that the stock market goes up 10% a year, the bond market goes up 6%, gold goes up 5%, and the average investor is getting just a fraction of that at 2.3%. That's tragically bad, and the number one reason why investors underperform all of the things that they're invested in is poor timing decisions around buying and selling, meaning freaking out when the market's low and selling, and then getting overly exuberant when the market's high and buying and at those high points, so buying high and selling low. So how can you tell the difference versus a seasonal change? So how would you know it's a panic attack or a storm versus a seasonal change? Well, there's actually a couple of ways that you could tell the difference. So number one, a seasonal change and what we would call a market crash tends to be a lot longer than just a panic attack. So for example, for a market to crash, it typically takes about 557 days on average. So think of this like years. This isn't going to be months, it's going to be years. So for example, the last market crash that we had was back from October of 2007 to March of 2009. Many of you remember this as the Great Financial Crisis. It took 517 days to go peak to trough, right? And then, of course, that's just hitting the bottom. Going from trough back to peak took up until 2014. So it took almost 6 years, peak to trough, back to peak, and that was an awfully long time for people to wait to make their money back. So the first sign of a market crash versus a pullback is the duration, right? Market crashes on average are going to be 4 times longer to hit bottom. And of course, they're going to take a long time to come back. So just think about it in terms of this is going to take years, okay? Pullbacks, on the other hand, are much, much shorter. On average, they're going to be about 150 days peak to trough. So that's an average of about 5 months. And you can see that some are actually quite short even in comparison to that. Now, we don't actually have the COVID-19 numbers in here yet, but COVID-19 was actually a pullback. And even though it was fairly deep, it was very, very short, less than 90 days for that full down and the recovery starting to come back up. So pullbacks are going to be months, market crashes are going to be years. The second thing that you can look at is market crashes tend to be a lot more severe. What do we mean by that? The drawdown, which is the amount of money that the market goes down, is on average 42% for a market crash, whereas a pullback, it's going to be about 18% on average. So 2.5 times as severe for a market crash versus a pullback. And then the last part is that market crashes tend to be 83% of the time correlated to recession, whereas pullbacks only 29% of the time correlate to a recession. Why is that important? Well, we have a recession risk forecasting tool, right? So we can't predict the stock market, but we can, with a certain degree of accuracy, forecast a looming recession. And if we know that there's a recession coming, that tends to be accompanied by a market crash. So we can definitely do a lot of things to protect and potentially even soften the blow of a market crash if we know a recession is coming. A pullback by its nature is going to be very unpredictable since it's not correlated to a recession. Our recession risk dashboard really won't be very useful in helping us understand when a pullback is coming or in even helping us get ready for a pullback. So what is our recession risk forecast telling us today? Well, the overall signal suggests that the economy is expanding and that there's a very low probability of recession. So you could see as of December 31st, and actually since then, the indicator has come out for the next month and nothing has changed. We can see that out of the 12 different indicators, 10 are green, 1 is yellow, and 1 is red. The red indicator, which is most concerning to people, is really the wage growth. And we know that wage growth right now is abnormally high because we have a labor shortage due to, again, COVID and some shifts in the labor market. We also know that the Fed has publicly stated that they're going to start tightening the supply of money. And that's reflected in our yellow indicator for money supply. That's not necessarily the Fed hitting the brakes yet. What they're essentially saying is we're not going to print any more money. So we're not going to loosen. And perhaps later this year they're going to start to tighten. So again, 12 indicators, 10 of them are pointing green, 2 of them are red or yellow, and so overall the probability of recession is very low today. In fact, if you were to look at the previous recessions that we've seen, you'll notice that they have a very, very distinct red and yellow look to them, and they're not really going to look very similar to the one that we've had today. Even the indicator right before COVID-19, right before that recession, was very, very different today. You notice that one had 3 red indicators, 3 yellow, and the rest green. And overall, the indicator was yellow at the time, pointing to a caution where today we're really looking at an expansion and actually a very quick expansion, I might add. So again, the recession risk forecast does not suggest that we're imminently headed for a recession. In addition to this, when we're looking at the gross domestic product of the country, and we're specifically looking at the year 2021, 2021 ended up being the highest growth year since 1984. So we really have to go back to the presidency of Ronald Reagan to see a growth year that was that high. Really what we saw was, coming out of the pandemic, there was a ton of pent-up demand. People really couldn't do things during the pandemic, and afterwards they wanted to do things, and not just do things, but do more for the time that they had missed. And so we actually saw a very, very strong rebound in gross domestic product. And this is real GDP. So real GDP means inflation adjusted. So some people would look at this and say, well, yes, Carl, this is great, but isn't inflation very high? Yeah, but inflation's actually factored out of this number. So in fact, the economy grew by much higher than this. But of course, inflation was higher than normal. This is factoring out inflation. So essentially taking out any of the variability from price increases and saying just pure growth. What has the economy done? And it's close to 5.5%, which is fantastic. That's the highest growth rate since 1984. So a couple of now indicators, whether it's the recession risk indicator or gross domestic product, have shown that the economy is really not in danger of a recession. And in fact, if you look at case studies from before, whether it's the early 90s, like I'm showing here, the indicator again went from green to yellow to red. And in this case, it predicted the recession actually much earlier than we ended up getting a recession in 1990. That was largely due to some of the economic pressures ahead of the Gulf War, which of course the indicator could not predict. But in this case, you could see our indicator was ahead of that recession. In the late 1990s, this is the tech bubble that many of us lived through. You can see again green, then yellow. The market peaked, it went to red, and then we were off to the races on the way down. And again, a lot of people assume 9/11 really was the cause of this recession. You can see the recession started before 9/11, and the market actually started dropping even prior to the start of the recession. But our indicator was actually great at helping us get ready for that by alerting us well ahead of time about the possibility of a market turn. Here's 2008 through 2009, the most recent recession that we saw. This is the Great Financial Crisis. And we could see here that, again, green, yellow, red, and then boom, we were down. And you can see here the recession started a couple weeks later. Lehman Brothers bankruptcy, which many of us remember, happened a couple months after that. And this is the one that took almost a year and a half to hit bottom before it started to come back up, and 6 years to recover from. And here's COVID-19. And again, you could see green, here's yellow, and then red almost instantaneously when we shut down the economy. And one thing that was really interesting about this last recession during COVID-19 is it may not even end up qualifying as a recession. It was just too short. A recession by its definition ends up being 2 calendar quarters in a row of negative growth. We actually didn't end up getting that. We got 1 calendar quarter of negative growth. And really by the third quarter of 2020, we really we're back to growing. So this may not even be classified as a recession. But if you look at the fourth quarter of 2019, we certainly had a lot of warning signs that recession was coming. And I really believe that the government artificially pulled forward the recession that would have happened anyway through the lockdowns and stay-at-home orders that they had enacted to really just kind of help the spread or stop the spread of COVID. But shutting down nearly 1/3 of the economy was what kind of pulled us into recession early. Without it, that recession probably would have been pushed forward a little bit or pushed backwards a little bit. So if we look at the business cycle, and again, we think of it distinctly in seasons, right? We can have storms at any time. But what season we're in matters, because the season that we're in helps us understand how to think about it from an investment standpoint. And right now, we believe at Verde that we're really in spring, and firmly in spring at this point, headed into summer. So spring's actually a fantastic time to be invested. and it's important not to overreact. So what are we recommending Verde clients do at this time? Well, number one, if you're finding that the recent volatility is just too much, and you're finding that your portfolio is very volatile and it's making you anxious, one of the things that you can do is update your risk tolerance, right? So imagine we're in a car together, and as your advisors, we're in the driver's seat. We're there to kind of help to get you to your destination on time. So we got to go. We can't just drive 0 miles an hour. But we also want to get you there in safety and comfort. So to make sure that you feel safe and comfortable, periodically from time to time, we're going to ask you to update your speed limit, right? Which is how fast you're authorizing us to be able to go for you. It's always a little bit of a balancing act between risk and return. So the faster you're willing to go, the bumpier the ride, but the quicker you're going to get there. The second aspect of this is once we've updated your risk tolerance, we're going to be going through and rebalancing your portfolio. And even if you don't update your risk tolerance, when we do look at market dislocations like this, not everything goes up and down at the same rate. So some investments get hit harder than others. And if we have conviction behind those investments, we're going to want to buy into that weakness and be opportunistic with our money, right? It's important to take profits from investments that have gone up and buy investments that have gone down. Rebalancing actually can add 1% to 2% to the return of a portfolio in a year. So actually these types of market dislocations are not necessarily bad for us long term. And then number three, we like to deploy excess cash reserves. So today with inflation being above 6%, any extra money that you keep at the bank will lose purchasing power. So if you'd like to be opportunistic, use some of that extra cash to buy into the stock market. Buying out of favor stocks may enhance your long-term returns, and any money you add to the stock market should be considered long-term from an investment perspective. So don't put money in the stock market that you're going to need in a couple of weeks or a couple of months. Put money in the stock market that you can leave there for a while. So again, my name is Carl Sass. Thank you again for your attention. We value you as clients. Feel free to call us if you have any questions. But that concludes our market update and our recession risk forecast update. Thank you.